Hey, good morning, everyone.
Good morning,
Yeah,
Professor.
good morning, Professor.
Hey, good morning. Good morning. Well, I see. Okay, it looks like I have 15 people here in the collaborate session, and um, let's see. Let's take a look at today's forum, and I see 17. I see 17 people in the today's forum. So um, we can expect two more people to join the collaborate, but hopefully they're going to join us um, quickly, at least sooner or later. So let's get started. So we're moving on to the next topic, stock valuation. Okay, we're moving on to stock valuation today, and I'm having a bit of issue with the uh, with the PDF file today. One PDF file is not doing. Okay, I'll have to open it later because it's kind of running out of memory. So this file is something you have to download as always, right? When you start a new topic, right? Um, and the course materials, uh, go to the equity valuation, and then there are these files, right, that you must use together with the main lecture videos, right? So you should have downloaded them already. And then we've had like a couple of, I think we had at least one or two holiday. I think we had 12th was our holiday, right? Uh, yeah, we didn't have 12th, right? Did we have 5th? I believe we did because, um, and then we had 19th. So we had three classes so far, right? So we had January 29th and February 5th, and then 12th was a holiday. We had 19th. We've had three sessions so far, four including today's. So you might be wondering, why are they already grayed out? These things, aren't we still shouldn't? Well, as I said, even on even on the holiday, right? The pre-assigned videos, the videos are pre-assigned per schedule, so we don't have. You have a reading to do, or you have video to watch, even uh, on the holiday. Okay. Otherwise, if we don't go by the schedule, we don't, we cannot cover everything by the end of the semester. So bear in mind the videos are assigned regardless, um, and then even during the spring break, the videos will still be assigned so that you can, always study ahead. Okay, so you should always to get ahead of, you should stay ahead of the game. That's the only way you can win. You have you have to always stay ahead of the game. There's no other trick. There's no secret. You should stay ahead of the game. Now, so these videos were, already assigned and they are gone already, and what is current, active and current are these ones, these videos, right? And then we still have more videos to come. Um, so you should be caught up all the way to this, actually. You should be caught up all the way um, stock valuation part 21. Okay. And as I said, um, and I don't have to say this, it's always posted in the announcement uh, that you can find past videos, right? There's, yeah, how to retrieve the lectures that are more than 1 week old, right? And, I have YouTube channel. And so the ones that are past, you can always look it up. Okay. Now, so we are if you have already watched these videos, you would know this is something to just to read. So I'm not going to talk about that. Uh, I want to get started with the um, okay. So in stock valuation models, right? Let me open. This is something you already learned from Finance 100, right? Okay, this is the one. So I guess no further explanation is necessary, but um, there are 4 stock valuation models, right? First one is a constant dividend model or zero growth model. Constant dividend or zero growth model, right? Which is, basically, this is what I don't like. So space is so limited. Um, value of the stock is dividend over R. Okay, dividend over required return. Now the dividend here is literally constant dividend. So dividend doesn't grow. Um, so this is not a very common pattern, but there are companies that um, pay just the same dividend over and over every quarter. There's no Usually the dividend is the result of dividend is correlated with the net profit. So if the net profit goes up, dividend is supposed to go up, but or net profit goes down, dividend is supposed to go down together. But in this case, there is no such thing. The dividend stays constant. Therefore, there is no growth. Hence, zero growth model. Okay. Now, there are things that need to be discussed. First of all, why obviously V0 is the symbol for price of the stock at time zero, but the price we are talking about here is the intrinsic value, not the market price. And in the bond valuation, we also talked about the intrinsic value of the bond, not the market price of the bond. And I've been telling you there's a difference between the book value and market value and intrinsic value. Okay, the difference between book value and market price, right? Market price is not value, is price. And the difference between those two things and intrinsic value. Okay, so that we got to start from that, but I'm going to give you these four models first, and then get to that point. Okay, the second model, second model is golden growth model. Yeah, I'll write it later. Constant growth model, constant growth, or also called golden growth. Golden growth model. Now, the constant growth means this may be, even if you have all taken Finance 100, that's why you are here. But there can be still, it can still be confusing to some people. This constant growth sounds, similar with, a constant dividend, but this is actually, they mean completely opposite things. They mean completely opposite. Now think about it. Constant growth means constant dividend growth, right? Constant dividend growth. So that means the dividend is growing at a constant rate, right? Dividend is growing at a constant positive rate. But as opposed to that, constant dividend means dividend is always constant. So that means growth is zero, right? Growth rate is zero. So they are opposite, actually. They are quite opposite. Okay, and the model is so the model is V0, right? Value of the stock at time zero, intrinsic, is the dividend at time t plus 1, next period, dividend over R minus G. Of course, R is the required return, right? And G is the growth rate. Think about it. R, required return, means, that's the discount rate. Okay? Discount rate. In other words, we all know all valuation models, right? Stocks or bonds, all valuation models are basically, all valuation models are discounted cash flow model, discounted cash flow, right? Remember, discounted cash flow model means, you are discounting the future cash flow to arrive at the present value. And in case of bond, it is quite obvious. The future cash flows, there's no, it's very certain, right? In case of bond, the future cash flow is quite predictable and it's quite certain. That's why we started with the bond, right? It's the coupon payment. What else can there be? Every 6 months, coupon payments. And at the end, the last coupon payment and the face value of the bond. You are discounting all those cash flows, right? Hence, discounted cash flow model, right? Discounted cash flow model. In case of stock, the expected cash flow is the dividend, right? Expected cash flow is dividend, but the dividend has a lot of dividend isn't constant um, like the bond, coupon in the bond, right? Dividend can be sometimes dividend can be constant. That's why we have a constant dividend model, right? Or zero growth model. But most of the times the dividend uh, fluctuates, right? So there's more variability. There's more variability in forecasting the future cash flow, right? But still, the bottom line is the same thing. You are discounting the future cash flow. So stock is also stock valuation model is also a discounted a kind of discounted cash flow model. But in case of stock, it goes by specifically the name dividend discount model. Okay, dividend discount model. Okay, so that M is just model. There's actually think about it. Discounted cash flow. Discounted cash flow has meaning, right? It is actually a variable, input variable that enters the model, that formula, right? But in DDM, that M is not nothing. M just means model, right? So what is actually meaningful is that dividend discount, right? And hence we can tell um, dividend discount model is a part of discounted cash flow model. You all understand this symbol. That means this includes, right? In other words, this uh, whatever is on the that uh, whatever is on that convex side of that symbol is a subset of it's a subset of a bigger set, right? So that means dividend discount model is a subset or it's subcategory, right, of the discounted cash flow model. Okay, we got a lot of things to talk about, uh, especially when it comes to uh, the shape of this or morphology. Morphology, you understand what that means? Morphology, why it is structured that way, why it looks like that. Why is it r minus g in the denominator? Huh? Why is it r minus g? And why is it only a dividend at time t plus one? I mean, if it is, discounted cash flow model, I mean, wouldn't it have, dividend at time t plus one, t plus two, t plus three, and on and on and on, you know, uh, all the way to dividend at time t plus n? Hmm? But why only t plus one? And then why subtract growth rate from the required return? Now, all those questions, those things is something that should bother your mind. That should be, that should bother you really. Those questions should really bother you. I mean, that's the mind of a scholar, actually, right? Mind of an academic. Why is it like this? Why is it like this? Right? So we're going to address that because, in most classes, they just tell you this is the formula, memorize it. This is the formula, memorize it. And then you just plug in the. And I'm just appalled, in some classes, they teach you to use Excel's built-in function. Excel's built-in function, like, you use PV, FV, right? You know what I'm talking about. But the problem with that, the students don't think. They don't want to analyze. They don't want to analyze the problem, but they just, mechanically, they do it just mechanically. It may save time, but as long as you use Excel, when you build a formula into it, right? And then it still saves time. I mean, there's no, you're not doing the calculation, so it saves you time. But without much thinking, if they all use, let's see, I think this is the one. This is the one that's there. And that's the Excel file, right? This one, stock valuation. Let me see if it's the same thing. Yeah, it's the same thing. I don't think you can open it because the file with the same name is already open. Let's see. Yeah, it's still the same thing, S&P 500, beta, correlation, stock valuation. It's the same thing. Yeah. So I'm gonna okay, maybe I'll just use that because so you know what I'm talking about, when some professors, I don't know what they are thinking. They tell the students to use, like if it is present value, oh, well, just go to this, use present value and, look, this is nothing but data punching, right? And some students just, follow this, without much thinking. They just, then what does that make them? What does that make, right? What does that, make out of them? They just, they just turn into a data puncher. In other words, you're just doing the data entry, no thinking, right? Just like, driving by GPS only without thinking, without having a mental map in your mind. You just follow the GPS prompt. Okay? And that's not what this is all about. It's about fostering the ability to build that mental map, right? And the map is some kind of structure. You need to have that, problem-solving model to solve the problem, and that model is some kind of structure, right? Some kind of architecture, right? Architectural structure. It's a program, or it's a coding. You're coding a program. You're coding a program into, or you're building a code into Excel, which can solve the problem. But this is the whole purpose of learning this, But then these professors or instructors or whoever, they think, just teaching you what formula to use, in other words, what commands to use, they think that is cool. No, that's not cool, right? It really is useless. Those built-in functions, right? Those Excel's built-in functions are useless unless you can think, unless you know why you use that, and where it falls in the grand design of that structure, right? But without understanding the grand design of the structure, you just become you just punch in the number there. You're doing the data entry. You're not a problem solver, but you are just data puncher then. So that's what I don't like. That's what I don't like. So anyway, back to so third model. So I'm gonna pick up speed a little, because and then the third model is the variable growth model. So think about it. The second model is constant growth model. Fourth model is the variable growth model. And the third variable growth model is an application of golden growth model. So I'm not going to write it here because it's got some component of straightforward discounting. Discounting, in other words, of the dividends, and then constant growth model, right, combined together with the present value of all the dividends. The fourth model, fourth model is free cash flow model. It's called the free cash flow model. Free cash flow. But then here's the thing. As far as the methodology is concerned, in terms of methodology, the way it is implemented, it's like an application of number 3. Similar to model number 3, but the only difference is that, think about it, all of these models, number 1 through 3, right? Whereas model number 1 through number 3 are DDMs, right? Dividend discount model. But number 4, free cash flow model, is not a DDM. This is not a DDM. In other words, this is not a dividend discount model. So what is that discounting? Instead of dividend, it's discounting the free cash flow. That's why it's called free cash flow model. So the reason for free cash flow model number 4, is that not all the companies pay dividends. Some companies don't pay dividends, and especially the growth farms don't. Growth farms don't pay any dividends. Why? Because the growth farms need to. They must be a penny pincher. They must become a penny pincher. In other words, the growth farms must grab every penny to reinvest in their growth. Okay? Therefore, they have no leeway. They don't have any room for paying out dividends. They need to reinvest all of their earnings back into the growth or expansion of the company. So they cannot pay dividends. And the shareholders, stockholders, don't mind. I've been telling you this over and over. The owners don't have to, the stockholders are the owners, right? Stockholders are the owners. And the profit belongs to the stockholders, right? Profit belongs to, it's theoretically, they say profit belongs to the shareholders. So then are the profits distributed to the shareholders? Hmm? This is not a rhetorical question. This is a question to you. Is the profit distributed to the shareholders? Anyone? Come on, nobody's. I see 19 people. 18 people here. Yeah, Damien.
I'm gonna take a shot at it, Professor. I think the profits are not distributed to the shareholders.
You're right. Profits are not distributed to the shareholders. Not at all. Why? Because if you have, let's say if you're an Apple shareholder, right? And if you're holding, 10 shares of Apple, Apple is, I don't know, currently it must be somewhere around $200, maybe lower, because, over the last, couple of weeks, the stocks really got, really got beaten up, right? Stocks plummeted a lot. In general, the market lost about, at least somewhere around 10 plus percent. And coupled with, Ukraine, the crisis in war in Ukraine, they really plummeted. You can look up where Apple is, but, we can do that later. But, let's say Apple is $200, right? And then we all know, basically, this is finance 230 or business 210 thing. The fundamental analysis, right? Balance sheet and income statement, right? First of all, income statement. And why? Because profit, to understand, how much profit the company made, you have to look into the income statement. And the income statement consists largely of income and expenses, right? The primary source of income is the sales revenue. Secondary source of income is what you can call passive income. Passive income is something like investment income. Or rent and things like that. Sales revenue is literally all companies must sell something, right? All companies must sell something, and that's revenue. What you receive for selling something, that's revenue. So sales revenue is the result of the active operating activity, right? But investment income like coupon on the bond or dividends or rents, those are passive. You don't do anything to you don't engage in anything actively to earn that income. Now, then expenses, the primary source of expense is CGS, cost of goods sold, right? which is also called, total variable cost in microeconomics, which is also called direct cost. And we did this also in Finance 100. At least, the balance sheet and income statement. You did that in Finance 100. And then the secondary source of expense is OPEX, right? OPEX, operating expenses, which is roughly equivalent to a total fixed cost in microeconomics, which is also called indirect, right? Indirect cost.
Can you please write a little more plainly, please?
Write more plain terms?
I can't really read that. Can you write a little plainly?
Yeah, sure. CGS is cost of goods sold, right? Right? OPEX stands for, of course, operating expenses. And TVC, total variable cost. I want, okay, that's too long. I want to write C. C would stand for cost, of course. TFC, total fixed cost, right? Total fixed cost. Now, then think about it. Profit is basically, income minus expenses, right? So, right? So you subtract, you subtract expenses from income, right? Then it's profit. Yes, but this is not net profit. It's called actually operating profit or operating income, right? The result is called, so if you subtract it, the result is called operating income, or this is what I don't like about accounting, but there's a good reason. They sometimes call this operating income or operating profit. So in other words, they use the term income and profit interchangeably. But then, does that mean this can be replaced by the term profit? Does that mean this can be called? Can it be called profit? No. Right? That's gross income. In other words, that's the gross state. So that cannot be replaced by profit. Profit is something after subtracting, right? Revenue minus expenses. In other words, profit is something after netting out expenses. So from this point, you can call it profit. And I always, hated why in accounting they use these terms interchangeably. But of course, there's a reason. There's a good reason for that. But to most, until you get to that point, until you get to that advanced level, it is still a a very bothering thing. It's very bothering, or because it is confusing. Why? But so I prefer, actually, instead of calling this operating income, I prefer calling it operating profit. Okay, that makes it, but operating income or operating profit, it's the same thing. And another name for that, another name, anybody? Anybody?
The EBT.
Right. EBIT is called EBIT, earnings before interest and taxes. So now you can tell, oh, earnings is the same thing as profit. Earnings mean profit. Yes, that's the same thing. So, okay, so who was this?
Sabrina.
Sabrina. Okay, Sabrina. So you'll get 0.5, and also Damien. I believe you answered my question a while ago. So Damien, you get 0.5. So and then okay. Then you have to pay interest, right? Why is there interest? I mean, where does that come from? Now, interest, you have interest because of the capital structure. In other words, in the balance sheet, you have debt, right? If you have zero debt, of course, there will be no interest, but still, I will still put interest payment here as a line item. And if you don't have any debt, this will be just left as zero. If you have debt, whatever interest it will be, this line item will be positive number, right? And then, so if you subtract interest from operating income, then this is called what? Now, first, let's think about it. If you follow this nomenclature, I mean, this I personally prefer this nomenclature. This, in other words, there's a logic in the naming, right? There's a clear logic in the naming because it says earnings before interest and taxes. We know what's going to come next because it's already, self-revealing, isn't it right? It's self-explanatory and self-revealing. Because it says earnings before interest and taxes, we know what it's already telling you what is coming next. And what's coming next? Interest, right? Because it says before interest and taxes. So what's coming next is interest. So you subtract interest. And then following that naming logic, what should it be called now? After paying interest, what should it be called now? Anyone? If you are typing into the chat box, please understand, I can't see it, right? I can't see it. So there's no, say it, but I'm sharing the screen. So what I can see is this screen, not the chat box. So anyone? After paying interest, what should this be called?
EBT.
Yeah, EBT.
EBITDA.
What?
EBITDA.
BTA?
EBITDA.
Oh, no.
EBT,
EBIT was there.
EBT.
EBT. Yes. Who said EBT?
Sabrina.
Sabrina. Okay. Sabrina, you got another 0.5.
I said
Yes.
EBT too.
Okay, who was that?
Ebony.
Ebony.
Yes.
Ebony, so you got also 0.5. Yes. Think about it. It should be EBT because interest is gone. From EBIT, interest is gone. Right? Interest is gone. So EBT. And what would be another name? I mean, if we follow this, this column, right? If you follow the naming, the nomenclature this column, the nomenclature of this column, what should it be called? What would be the best name? Think about it. It's earnings before taxes, isn't that right? It's earnings before taxes. Then what should be the another name for that? Anybody? Oh, please! I said, if you are answering, if you put your answer there in the chat box, I can't see. So say it out. Speak it up.
I'm gonna try. Is it operating cost?
No.
No, right? No.
Operating cost is, this is operating cost. Okay? Why is it cost? I mean, we have subtracted all the cost, right? And the name is operating expenses, not operating cost. Anyone?
I was gonna say net profit, but I
No.
thought that comes later, right? That comes after.
Because you are still before paying taxes. If your earning is still before paying taxes, what should it be called?
Earnings before tax.
Yeah, but that's just spelling out this. That's earnings before taxes. I wouldn't be repeating the same name here again. If it is earnings before taxes, what could be another name for that? Huh? Just think logically. There should be some logic here.
Profit.
No, it's not. Yeah, it's a kind of profit, but I told you, earning.
Would that be taxable income?
Yeah. This is called taxable income. Think about it. If it is the earnings before tax, I mean your earning is at the stage or in the state right before getting taxed, then what should it be called? It should be called taxable income. Isn't that right? And who said that?
It's me, Professor Damien.
Damien. So Damien, you got another 0.5. Yes, it's called taxable income. And then what should come next? What is next? What's coming next? Think about it. Isn't it logical? If it is taxable income or earnings before taxes, then what's coming next?
Would that be the net income then?
Why income?
No, I'm saying net profit. Pardon me, net profit.
No. You cannot get to net profit before doing this. Come on, guys. This is just logical. I've been telling you, EBIT is the reason I like this nomenclature, like EBIT, EBT, is because it's self-revealing and explanatory or self-foretelling. Self-fulfilling is, huh?
Let me take a shot at it. Is it cost of goods sold?
No. How can it be self-revealing then? I mean, if it is cost of goods sold, how can it be self-revealing from EBT? Think about it. There's no logic there. The cost of goods sold is already here. This is the cost of goods sold. We subtracted that. That's how we could arrive at EBIT. Right? All of those logical processes so far, you simply defeated all that logical process.
Just earnings? Earnings?
Earnings, I mean, taxable income is earnings. It's earnings before taxes. So from the name earnings before taxes, it should be already self-predicting. What should come next? Yes. Yes. And who said that?
Carter.
What? Carlos?
Carter.
Carter. Oh, so your last name is Carter, right? Okay, Carter, you got 0.5. Yes, that's only a logical conclusion, isn't that right? It's earnings before taxes. So what comes next should be taxes, right? So you subtract. Think about it. From EBIT, earnings before interest and taxes, itself already predicting what comes next. What should come next? Interest should come next, right? Because it's earnings before interest tax. And then you subtract interest. So then you arrive at EBT, earnings before taxes. From earnings before taxes, right? It should be obvious, it's self-predicting what should come next. Taxes must come next, right? Okay. So then you subtract taxes, then what should come next? After you subtract taxes, then what is it? What's the result? After subtracting
income, right? Income.
Net income.
Net income?
Net income, yes, or net income or net profit. Net income or net profit. But as I said, here, calling it income is, I'm not saying it is wrong, but I'm saying it's not preferred. Profit, calling it profit is preferred, right? Net profit. This is finally net profit. But again, you have to understand we have another column of nomenclature. I mean, we call it also, and then if we follow this naming logic, what should it be called now?
Earnings.
It's earnings, but but earnings have been repeated over and over. I mean, it was EBIT, earnings before interest, and EBT, earnings before taxes. So now, what should it be called?
Oh, net earnings.
BT.
BT? No, it cannot be BT because BT means before taxes, right? But you have paid taxes already. So what should it be called?
So will this be after taxes?
Yeah. But what is so?
No.
Say that again. Say that again.
So is this earnings after taxes, or?
Yes. And who was that? Carter again. Okay. So it should be called EAT. Okay, Carter, you got another 0.5. It should be called earnings after taxes. Okay, earnings after taxes. So net profit, net income, EAT, they all mean the same thing. Okay, they all mean the same thing. Now, the reason I brought you all to this point is because so who does this belong to? Who does this net profit or EAT belong to? Who does that belong to? Who owns the net profit? Who owns the EAT?
Is
The
that the
company?
company?
The corporation?
No. Corporation is only a whole. Corporation is only a company is only a whole. You understand? Company is only a vehicle, right?
And the shareholders.
Right. That's what Damien said in the first place. Who does the profit belong to? It belongs to the shareholders, right? But do the shareholders get this profit distributed? It belongs to the shareholders, but do they get this profit distributed?
No.
No, the answer was no. Why? Because if they want to recoup this profit, all they need to do is sell their shares, right? They only need to sell their shares. That's why I've been telling you, they don't companies do not distribute the profit to the shareholders, and that's especially if it is a growth farm. If it is a growth farm, they need to grab every penny to reinvest in growth. So there will be no dividend, or there will be no profit being distributed to the shareholders. Although the shareholders are the owners, right? That doesn't mean the shareholders can demand, oh, that's mine, so you know, pay to me. No, if you want it, you can just simply sell it, right? And the share price that you will sell it for will reflect exactly this earning, right? Theoretically, exactly by the new share price must exactly reflect this earning, but the market price will be uh, either above or below that, right? But you can tell if you have 10 shares of Apple, and Apple last year, if Apple was $200, and this year, if Apple is $250, by selling your shares, you recoup not only your initial investment of 200. I mean, let's say last year you bought Apple for $200 per share. This year, Apple is 250. Why is it 250? Because $50 is the net profit of from the operating for 1 year this year, and it should be reflected. It will be reflected in the share price, and the market price would be it can be exactly reflecting the this profit, or it could be above or below. But whatever market price you are selling it for at that price, right? The That price represents your initial investment plus the profit in the during your holding period. So by selling the shares, you recoup all that. Okay, does that make sense? Right? How come there's no? All right, does that make sense?
Yes, Professor.
Huh?
Yes, sir.
All righty. So let's see. Now it's 10:33, so I think it's a good time to take a break. So let's take a 10-minute break. Okay, let's take a 10-minute. All right, we're back. We're back. So, okay. Now, in the meantime, I see 18 people. 18 people have joined us so far, and let's check how many are in the. And I see 21 people. 21. So 3 people still need to join us. But let's get started anyway. Let's get started. The reason, okay, in the previous session before the break, basically you understand that there is a difference between the market price and the book value, and the profit is not directly distributed to the shareholders. So in other words, what that means is we already know, this is something you know already. I mean, I don't think I need to repeat this. There's a book value per share. Okay? And what's book value per share? Book value per share is basically the equity, right? Total equity, equity value, right? So if this company raised, when it first went public, right, at IPO, right, if it raised, they sold the stocks for the first time, okay, to the public. That's why it's called IPO, initial public offering. And then they sold 10 million shares, and if 10 million shares were sold, original their original target IPO price was, let's say, $60. But if the price by the end of that day, by the end of the trading, was $100. So think about it. This would be $100 per share times they sold 10 million shares, let's say. And then we know what this would be, right? 10 million times 100. So that's like, then 1 billion. It's 1 billion, right? Total equity value is 1 billion, isn't it right? 3 zeros. And let's say they sold a number of, and if you divide that by number of shares, and the number of shares, let's say, was 10 million shares. We already, right? They sold, 10 million shares, right? That's why 10 million shares, right? Then book value per share is $100. Okay? And that's at time zero, right? At IPO, in other words, when they first, okay? Book value per share is literally, think about it, per share means, when we say per something, that means you divide it, right? Per capita, GDP per capita. What is that? GDP divided by number of heads, right? And in the US, there are about 300 million heads, right? So if US GDP is 21 million as of, I believe, as of end of 2021, it must be about 22 million, 22 trillion, 22 trillion. You divide it by 300 million, right? Actually, it would be more than, the population of the US would be more than 300 million, but, if it is 350 million, you divide it by, 350 million, 22 trillion divided by 350 million, right? That's per capita income. So when we say book value per share, divided by the number of shares. And okay, look, at the end of the day, on the day of IPO, at the end of the day, the price was 100. Of course, that's market price then, but that's the price that was registered, that gets registered in the balance sheet. That's the price that gets registered in the balance sheet at time 0. So that becomes the book value per share, right? At time 0, right? Everyone? You follow? And
Yeah,
think
so far,
about it.
Professor. I got a quick question,
Okay,
Professor.
hold on. Please hold the
Okay.
thought. Let me finish this first. Let me wrap it up. So when we think about it, when we do the fundamental analysis, we need at least 2 balance sheets and 1 income statement, right? Why? We need balance sheet at time 0 and at time 1, because balance sheet at time 1 is at the end of the year. Balance sheet at time 0 is at the beginning of the year, or in this case, whenever it was first made public, right? Sold public to the public, right? At public initial public offering. And companies do not sell stocks frequently. Companies don't sell stocks frequently. I mean, after initial public offering, the second public offering may come years later. They don't, just sell stocks like selling, a bag of potato chips, or it's not, stock is not a good, right? It's not a merchandise. Stock is ownership. So ownerships cannot be increased or decreased overnight. I mean, if it happens, then the shareholders wouldn't like it, because the share price gets diluted if suddenly stocks. Think about it. There was IPO yesterday, or 1 month ago. The IPO was just 1 month ago, and they are making second public offering. Now this is crazy, because there will be more shares in supply. And think about it, if there's more supply, always the price goes down. And then existing shareholders will suffer drop in their value of their holdings. So existing shareholders don't like it. Existing shareholders include not only minority shareholders like you and me, but it also includes mainly the majority shareholders, who have controlling interest, right? And the major shareholders would definitely not like it. So the number of shares hold constant for quite a long time. Okay. Anyway, so the point is, so 1 year later, so I said you need two balance sheets, the balance sheet at time 0 and time 1, and income statement, one income statement. And the income statement, think about it. Income statement is always the result of, operating for 1 year. So it's the year end. It's the year end result, right? The income statement is the year end result. So the EAT, or net profit, in the income statement is at time 1. EAT at time 1. So think about it. If this represents the profit if that represents the profit at the end of year 1, then if you divide this, because this is total profit. In other words, aggregate. Profit means aggregate concept. EAT is the result of the operating for 1 year. So this is an aggregate concept. So think about it. Per share concept of EAT will be what? What will be the per share concept of EAT? When I say per share, that means there are 10 million shares outstanding. Isn't that right? So if this profit was $100 million, if this was $100 million, right? Obviously, that's not profit per share, isn't that right? So how do you find the profit per share? How do you find profit per share? Just think logically. Profit per share must be EAT at time 1 and divided by number of shares. Isn't that right? Isn't that right? Nobody's saying anything.
So, Professor, that would be the 100 million divided by the 10 million?
Yes.
Okay.
Then what should it? Yeah, it will be 100 million divided by 10 million, right? So then we know the number will be then $10, right? Number will be $10, right? But what is this called then? What should this be called?
What, we using dividend for this one or not?
No, we're not talking about dividend, right? Before dividend, there should be profit, right? And this is profit per share. Isn't it right? Because you are dividing net profit by the number of shares. So it is profit per share. So you might say, oh, isn't that the name? I mean, profit per share. I already said profit per share. So shouldn't that be the name? Yes, it is the name, but that's not the official name. What is the official name? What should be the official name? Listen.
Like the EPS?
Yeah. Who is this?
Damien, Professor.
Damien?
Earnings per share, right?
Yeah, earnings per share. So who is this?
Damien, Professor.
Okay, Damien. So you got 0.5. Yes, this is called earnings per share. Okay, literally. And earnings per share at time 1, because it's EAT, earnings after taxes, divided by number of shares. So it should be called at time 1. So it should be called earnings per share at time 1. Right? That's the official name. Okay? So, I mean, that's profit per share. That, obviously that's that's what it is. I mean, that's the interpretation of that. But the official name is EPS, earnings per share. Okay? So the earnings per share is $10. And knowing that, and that's what happened at the end of year 1. So we know earnings per share at time 1 is $10, right? Of course, we know it is, EAT at 1 divided by number of shares. Then we can tell, then what should be the book value per share at time 1? What should be the book value per share at time 1? Anyone? Look,
$10.
book value, huh?
Is it going to be $10?
$10? No,
Oh,
$10 is, no, look, $10 is just earnings per share at time 1. Why? I already said $10 earnings per share is $10. Then why would I mean, that cannot be the same thing as book value per share. Book value per share at time 0 was 100. Earnings per share is 1. Earnings per share at time 1 is $10. Then what should be the book value per share at time 1? Oh, come on, guys. This is just logic. Look, remember, I said the company doesn't distribute the profit, right? So if you want to recoup the profit, what should you do? What do you have to do? You answered this in the previous hour. Profit belongs to the shareholders, but the company doesn't distribute the profit directly to the shareholders. So for the shareholders to recoup their profit, what do?
They sell their shares.
Yeah, they sell their shares. And I said, if they sell their shares, the share price will reflect first, your initial investment. In other words, you paid $100 at time 0 to buy this share, and at time 1, the price will reflect not only the original your initial investment, the original price, but the profit for 1 year.
Which is the $10. So it'd be $110.
Yes, you're right.
Right.
It has to be
Okay.
$110. Okay? It has to be $110. That's what book value, in other words, book value per share at time 1 is exactly, come on, give me a, okay. Book value per share, It's book value per share at time zero, right? Plus earnings per share at time 1. Okay, so therefore, $110, right? Look, this is clearly, I mean, very logical and very straightforward. It's simple. There's nothing, mysterious about this. But the thing is, once again, I've been telling you, market price will be however, book value per share and market price may or may not be the same thing. Most of it, it could be, because think about it. I've been telling you all this time, market price is determined by demand and supply, right? So market price is not constant. Market price can change every second, right? Because every second, every minute there's trading and there's transaction every minute. So market price can vary every minute, every second. That crazy fluctuations is all market price. Now, so P is the market price, right? That's the symbol for market price. So book value per share and market price are not the same. But they may be, if the market is correctly pricing, this asset, then it must be equal, right? If it is correctly pricing it, it must be equal. But most of the times, it's misaligned. Most of the times, either market price is greater or market price is lower than the book value. But think about it. Market is constantly, book value is only determined, a book value is not determined at every second or every minute, right? Why? Can anybody answer? Book value isn't determined every minute or every second. Why? Think about it. What is the frequency of the data? What is the frequency of the book data? In other words,
That's quarterly, right?
quarterly, yes. I've been telling you, companies release their earnings report every quarter, quarterly, at the end of every quarter, right? Of course, it cannot be first quarter ends on March 31st. It doesn't mean on March 31st they release the data. They can't, because when the quarter is over, they will have to close the book. In other words, they will have to update everything and compile the data. It takes time to process the data, right? Theoretically, it has to be on the last day it's only as of the last day of the quarter, but for the data to be available, right, it has to be sometime later than that, right? So think about it. Fourth quarter data was data compiled as of the end of December 31st, 2021. But then they need to process the data. They need to collect the data first and process the data and compile the data. And when the earnings data is released, that will be in January, right? So the fourth quarter data is only available in January. First quarter data will be available only in April, right? So think about it. We are we are in the first quarter of 2022, and is almost, we are close to the end of February. We still have one more month for this quarter, for the current quarter to run out, right? Until then, until April, the most recent data, book value data we have, most recent data we have is as of fourth quarter last year. Isn't it right? So in other words, this earnings per share at time one is as of fourth quarter last year. Book value per share at time one is as of the end of last year, right? As the end of last year. So therefore, in the meantime, there's only market price. I mean, until the next book value, until the next concrete data on the book, we'll have to wait another month. So that's why the book value isn't something that you can get every minute. We don't have changing book value every minute, right? Makes sense? But the market price is changing every minute. Because there's trading, there's transaction every minute. Maybe not every minute, but still, like sometimes the trading is very slow, sometimes, fast, crazy, so but at least if the trading, whenever there's a trading, there's transaction, and with the transaction, you have market price. So that's why the book value per share and market price are not the same, cannot be the same. Sometimes it can be the same when the new data is released, when the new earnings, when the performance, right? When the new performance data is in, and the new performance data will be in at the end of March. I mean, but it will be released in April. Until then, right? We don't have any clue about concrete data about the performance of this firm, right? And most of the times, think about it. In the past quarter, in the last quarter, in the most recent quarter, if the company had earnings surprise, meaning, positive surprise, what does that mean? Oh, the company did much better. Company did much better than expected. In other words, earnings per share 1 was much better than expected. And that's called positive surprise. Earnings surprise, and it's a positive surprise. Then obviously, well, what's going to happen? The positive expectations about this company will build, right? The positive expectations will build up, and the positive expectations will cause what? The positive expectations will increase the demand for this stock. Isn't that right? The positive demand, the positive expectations will drive the demand for this stock up. Right? The positive expectation will drive up the demand for this.
Professor, that's what will increase the market share? The market,
No, it will increase the market price.
The market price.
Then
okay.
it will increase the market price. It will increase the market price. So if that's the case, it will be like this. Market price will be greater than book value per share. Make sense? This is the analytical framework, right? Not just arbitrary, random, just wild, freewheeling thinking, but follow the logical framework, analytical and logical framework. And if there was a negative surprise, then it's the opposite. if there was a negative surprise, in other words, they didn't do well. Earnings per share was, very small or even negative. Well, what's going to happen? It will drive down the demand. If it drives down the demand, then the market price will drop because the demand goes down. The price will go down, and then most likely the market price will be less than the book value per share. Okay, makes sense? But again, here's the thing. Now you understand, the difference between the market price and the book value. But then,
Professor.
yeah.
So it is possible for a company's book value per share to be higher than the market's value per share?
Yeah, yes, of course. I just explained that.
So if that's the case, would you, if you were to sell your assets, would you sell it in the market's price or what? At the market's price or what? Or the company's?
You have to look at it in the long term, because sometimes the company's fundamentals are good. This company is, basically the fundamentals are good. There's no reason for there's no reason for this company to continue to lose stock price in the long run. I mean, if this is just a negative surprise in the short term by some, unexpected, ad hoc factor.
Like COVID, right?
Yeah, like COVID. Then
Right.
there's no reason to, or, war, like in Ukraine, for whatever reason. I mean, every company suffered some sort of, although they are fundamentally good, every company suffered some sort of negative surprise in earnings due to supply chain disruption, right? And but supply chain disruption is not a permanent thing. It's going to be, eventually, it's going to be relieved eventually. So if there was a negative surprise in earnings in the short term, no reason to sell. Okay, it's going to correct itself eventually. But something like, wage increase. Wage increase is permanent. I mean, due to inflation, wages increase too. I mean, wages is, a big part of, inflation. So it's like, catch-22. I mean, it's like catch-22. First of all, due to supply chain disruption, cost went up, right? Because all manufacturers, think about it. Because of, short supply, microchips got more expensive. If microchips, the semiconductors, if they are more expensive, computers will get more expensive. Mobile phones will get more expensive. Whatever electronic device that uses, all electronic devices will get more expensive, right? But as I said, supply chain disruption is relatively short-lived. It can eventually, but when together with that, food prices are increasing, and all that causes inflation. And with food prices, gas price, especially if there's war in Middle East or in the oil-producing countries, then supply gets hindered, supply gets hampered, so oil price goes up. Now think about it. These are input costs. When input costs go up, prices of manufactured goods will go up. And with food price, gas price, everything going up, wages have to go up. But then wages have permanent effect, because wages don't come down. Once wages go up, wages can hardly come down. Usually, all prices are relatively flexible, but wages is called ratchet effect. It goes only up, but it cannot go down. Once your wage is up, and So the wages are up, and if the wages are up, then it fuels the inflation more. So something like wages will be permanently affecting uh, uh, the earnings, because when wages go up, earnings go down, right? So you have to look at the fundamental aspect of why there's a negative earnings surprise, right? And if this earnings surprise is due to some permanent uh, uh, fundamental factors, then you should sell before before it gets um, uh, before market valuation goes down further. But again, once again, book value and market price are not the only thing. Now, here's the intrinsic value. Think about it. Intrinsic value. What is an intrinsic value? Now, think about it. This is the important thing. Intrinsic. And intrinsic value, that's why I use the symbol V, because V stands for intrinsic value of the stock. I mean, you can, P is the market price, book value per share, B, that's the book value, V is the intrinsic. But what's the V? Remember, I've been telling you, in finance, all valuation formulas are basically discounted cash flow model. Because value of the financial assets is the present value of all future cash flows. That's why we are investing. If there is only book value is always past. Book value is always past, right? It doesn't tell you anything about futures, a company's future earnings potential. What is revealing companies, future earnings potential? Discounted cash flow, intrinsic value, in other words, intrinsic value. So think about it. Although we want to do this, but making this decision is making this decision just based on the book value is incomplete. Why? As I said, book value is based on the concrete data, but this is always past, right? No matter how recent, no matter how latest updated book value we have, that's already, I mean, we are already at the end of February. The book value, most recent book value of the company we have is as of December 31st last year. So just based on the book value and the market price, making a decision whether to sell or buy, it's not accurate. Okay, it's not, and so in the meantime, until, as I said, book value is only available quarterly. So between last quarter and end of this quarter, right, until the data for this quarter comes out, what do we have? We have to. That's why we need intrinsic value, right? And the intrinsic value is, look, the definition of intrinsic value, it's basically what? Future is the present value of future cash flow. And in case of stock, future cash flows are dividend at time 1, dividend at time 2. You keep going. dividend that time, the horizon, time horizon, H means time horizon. In other words, our terminal time, right? Time horizon. And the price of the stock at time horizon, our time horizon. But think about it. What's the time horizon? What's our time horizon? Stocks don't have time horizon. Isn't it right? The time horizon is actually infinity, because stocks don't have any maturity. As long as the company goes on, the stock will go on. Sometimes some investors have certain, finite time horizon. I'm holding this, stock. I'm holding Apple and Tesla until the end of this year, and I'm gonna sell them. Some people may do that, but think about it. If Apple and Tesla are still gaining at the end of the year, will you really sell it at that time, at that point? If it is still in December of this year, Apple has grown by 100%. Tesla has grown by 150% during the year, right? And it doesn't look like it's gonna go down in January of 2023. Are you going to, just because you plan to sell it at the end of the year, are you going to commit yourself to that and really, okay, I will sell no matter what? No, it's not. Unless you have to liquidate it, unless you have to cash out for whatever reason at that point, you wouldn't sell it. You would still keep it in, right? You will still keep it in your portfolio. You will still keep it in the stock, right? You're not going to. So, but then, somehow something happens and, something unpredicted happens and Apple loses, like 20%, Tesla loses 40%, and you might say, wow, I should have sold. Look, once again, you don't invest like that. When you invest, you should look at the fundamentals. And if the fundamentals are all positive, that short-term gyration or short-term, oscillation, short-term, volatility, you have to weather it out. You have to shoulder it, right? Because it's gonna correct itself later. I mean, if it was due to some, stocks suffered unnecessarily a lot over the last couple of weeks, and especially with Ukraine, the crisis in Ukraine, it took additional blow. But those are negative, surprises, ad hoc factors that were not predicted, and just that doesn't mean war in Ukraine doesn't make Apple a bad company. War in Ukraine doesn't make Tesla a bad company, right? If their fundamentals are positive, this short-term drop will be corrected, right? Later it's going to be corrected. So anyway, the point is, so intrinsic value is the present value of all future cash flows. In other words, discounted cash flow model, right? Discounted cash flow model. In case of stock, specifically, dividend discount model. But for stock, I told you, dividend discount models have four different variants. That's what I set forth at the beginning. First model, 1, constant dividend model or zero growth model. That's why I used, think about it, YV0. That means intrinsic value. Intrinsic value. Constant growth model or golden growth model. That's why V. Variable growth model. Again, we are looking for this, right? Intrinsic value. free cash flow model, we're looking for this, right? And then our next question is, okay, so, all right, I can understand, I can follow. I mean, the logic is clear. I mean, you guys are finance majors, and you should. So for you, it's clear what, you can understand what these, what this means. Can I? Okay, you understand what this means. This is basically discounting all the future cash flows. But then the question is, how does that turn into this? How does that turn into? How does that turn into this? How does it reduce to this? Right? How does it reduce to this? And how does it reduce to this? Okay, that's something we're gonna discuss in the next hour. Okay, because it didn't just drop from the sky. It just doesn't, they didn't conjure it up from out of thin air. I mean, think about it. Why is for me, it was me. I mean, I told you, it's the, scholar's mind, it's the scientist's mind, right? It's the economist's mind to question why. Why is the formula like this? I mean, you can understand why it is like this. You can understand why it is like this, right? You can understand why it's like this. But then how did it turn into this? How did it turn into this? How did it transform to this? And questioning why and how, that's the scientific mind. And that's the scholar's mind, right? And that's why I criticized some professors who are not teaching you why and how, but just giving you, use, present value function in Excel, use future value function in Excel. If they're just telling you that, then they're just turning you into a data puncher. They're just turning you into a data puncher, not turning you into a thinker. And that's a problem. Okay. All righty. So we'll have to take a break. Let's take a 10-minute break, and in the next hour, we'll see how that long polynomial reduces to that reduced forms, right? All righty. So let's take a 10-minute. All right, we're back. We're back. Here's the thing. I don't know where I put it, but I put all full models somewhere. But okay, I didn't do it here because that's something I always do with, in Finance 100. But because this is 300, I would, I must have, assumed that you know this already, So let me open my Finance 100 thing. Stock valuation, was it this? Why is it doing this? Out of memory? Okay. You see, I can preview it here, but why is it not? Okay, something's not right. Okay, it doesn't matter. It doesn't really matter. I'll just okay, that's all I need. So first of all, the first model, constant dividend model or zero growth model, how did it come to be reduced to this? In other words, the intrinsic value is intrinsic value is defined basically by now first, it's constant dividend model, so the dividend is always the same. In other words, it's you know what K is. K is cost of capital. So it's the same thing. Cost of capital is the cost of raising capital. So in case of bond, right, the bond yield is the cost of debt. For equity, the required return is the cost of equity. So you can consider K as the same thing as you can consider K cost of equity, cost of equity, as the same thing as R, which is the required return, right? And when the dividend is constant, that means there is no difference between dividend at time 0 or dividend at time 1. I mean, there is no difference. All these dividends are the same. They are equal. Dividend at time 2, they're all the same. So there's no need for the time subscript because it's the same thing, right? The time subscript would, the reason for the time subscript is to, basically indicate that these are different values at different times, right? But if the dividend is constant, growing, not growing, or growing at zero rate, 0%, there's no difference. So we will just have dividend with no time subscript, right? We'll have dividend with no time subscript. So so dividends are paid quarterly, right? Dividends are, and the dividends come out of the earnings. Remember, dividends from the where is the where did I put it? Oh, okay. From this EAT, right, or from this net profit or EAT, right? From that, they pay a small fraction. They pay a small fraction of EAT. Uh-oh, what's going on? Ah. They pay a small fraction of EAT as dividend, right? So usually, there's something called dividend payout ratio. Dividend payout ratio is literally how much of the EAT are we going to pay out as dividend. So, represented by lowercase d, dividend payout ratio. It could be, any number like 10% or 10 to 20%, right? 10 to 20%. They're not, as I told you, if it is a growth farm, growing fast, this will be zero, right? Dividend payout ratio will be zero, right? So once you pay out dividend, then it's called, the result will be called retained earnings. But so you can tell because it is paid out of the earnings, dividend is quarterly if they ever paid, right? If they are ever paid, it's it's quarterly. So dividend in the first quarter will be discounted like this, and that K would be quarterly, of course, quarterly rate, right? Annual rate divided by 4, right? And then the second one will be, second dividend will be discounted twice, 1 plus K squared. And the third one will be, 3 times, discounted 3 times. And we keep going like this, right? And then at the end of this, long polynomial, right? There will be dividend at time n minus 1. So discounting will be done 1 plus K raised to n over 1, if n is 30, that means that's 29, right? I mean, from the bond, this is not a unfamiliar concept. And finally, there will be last dividend and the value of the stock at time n, which will be discounted n times. Okay, but now think about it. Here's the thing. What is n then? I mean, n is, and for the stock, I told you, stocks don't have any terminal time. Isn't that right? Stocks go on forever. As long as the company goes on, the stock goes on. So for stock, n is practically infinity. Infinity. Right? And now let's think about it. Let's just break this down a little further. We can break it down into first, dividend. You can discount dividend 1 plus k raised to infinity. And this is, value of the stock at infinity, and you discount it by 1 plus k raised to infinity, right? But then what's going to be the value of the stock at infinite time? Huh? Now, suppose Apple, we don't know how long Apple's gonna go on. We don't know how long Tesla will gonna go on. Let's say in 1,000 years. I mean, 1,000 is not infinity. I mean, it could be trillion years or even gazillion years. After trillion, what was that? I forgot, but there's a word for that.
Quadrillion.
Whatever it is, huh?
Quadrillion.
Quadrillion, yes. Even in quadrillion years, right? And even, that's not even infinity. Infinity is, quadrillion raised to quadrillion, right? Quadrillion raised to quadrillion. But anyway, just that's, it's not easily, it's not easy to envisage. Even, it's not easy to envisage, right? Or visualize, even, 1,000 years. So let's say even 1,000 years later, if Apple is still existing, Apple still goes on, what do you think is the price of Apple? What do you think is the price of Apple at the time? Okay, let me ask you, let me break it down into this. Will this price be infinite, or will it be a finite number?
A finite number.
A finite number, yes. Who said that? Is that
Damien,
Damien?
Professor.
Okay,
Yes,
Damien, you got another 0.5. Yeah, it will be a finite number. And if you have studied the videos, you should be able to answer that. Why? Or some people may say, if you haven't studied the video, you will say, it will be an infinite number because why? It's going to be in infinite time in the future. No, just because it is infinite time into the future, infinite future, it doesn't make the stock price an infinity. Why? First of all, stock prices follow the business cycle, right? In other words, there's boom and bust, right? During the expansionary period, when the business cycle is upsloping, stock prices will go up. But when there's recession, stock prices will go down, and then go up again, go down. So it will be an endless cyclical pattern. Of course, the cyclical pattern will be over time. I mean, even imagining 1,000-year stock price in 1,000 years is already a very daring thing, because there hasn't been a stock market hasn't been even around for 500 years. The first stock market was, organized stock exchange was in Netherlands around 1600 something. So the stock market history of organized stock exchange, and we don't have we don't have much data about the stock market in Amsterdam at the time, but the written record, of the stock market data goes back only about 110, 120 years. So even envisaging like 1,000 years later, but we know for fact, right? It's been like this, but it's been an uptrend, right? Since then, right? Even just go back to a 1994. I remember in '94, I was getting ready to get on a flight, and in the morning, as I was leaving the hotel to get on the flight, the CNN news on that morning, it was like January of '94. The news, they were all excited. Dow Jones hit 20, Dow Jones hit 2,000, 4,000 or something like that. At the time, 4,000. Dow Jones hit 4,000. Dow Jones is about 20 something now, isn't that right? Let me just quickly. Dow Jones is 34,000. 1990. So let me, take a look at Dow Jones maximum chart. And make it monthly maximum max. That's giving me weekly. So 94, around 94, right? January, like, let's see, 94. Yeah. You see, 3,914. So I think it was slightly, slightly later than that. I mean, Dow Jones was, 4,000 around that time, and I remember, because and then think about it. Throughout the history, and Dow Jones goes further than that. We can. I can move it, but they've been the data provided was starting from '92, but it goes to even 1920 something. But the point is, you see this pattern, right? It's upsloping. I mean, there's ups and downs, but clearly upsloping. So even 1,000 years later, first because of the boom and bust, right? I mean, this is not necessarily the boom and bust. It would be more cyclical. This is more like short-term fluctuations. If I draw the cyclical pattern, the cyclical pattern would be more like this, cyclical, right? So anyway, it's not going to be, and then first, because of the business cycle, right? First, because of the business cycle, if you have lost train of thought, oh, why? What about the business cycle? I'm explaining why the price of the stock at infinite time is not infinity. One reason is business cycle. Two, probably most important, stock splits. Splits. Why? Splits. What are splits? Splits are basically, splitting the stock, right? If you currently, Apple is, let's say Apple is 200 something. I don't think it is 200 something. It's slightly below 200. It must be below 200. Let me. My holding, my portfolio, Apple. Where's Apple? Here. 164, right? 164. But Apple had a lot of splits over the years, right? Go to chart maximum. If I can turn it into monthly. You see that's the truncated. Those are dividends. They paid dividends, right? For almost 10 years, they stopped paying dividends, starting from 1996 until 2012. That's almost 96 through almost 20 years. That not 20, 15, but 15 years or so. They stopped paying dividends. They didn't pay dividends. They needed to, in those days, they needed to grab every dollar. And then they had, this isn't showing all the splits. If I use, more recent 5 years, right? Even in recent 5 years, you will see here's a split, right? Weekly data. Here's a split here, which happened in 2014, and here's another split. It was just last year, yeah, a 4-to-1 split. So stocks, if there was no split, if there has been no split, Apple's price should be something like Apple grew almost 1,700%, 750%. The beginning of Apple was monthly. Even annual. Let's make it annual. 1981, the beginning of Apple. In other words, Apple's IPO was 1981, and at the time the price was like this is like this is annual price, so I can't see that. $0.14. That no, you might no, it wasn't 14 cents. It was more like $14. More like $14. But why is it showing as 14 cents? Because they prorated. After each split, they prorated. Think about it. Split means in 2014 there was a 7-to-1 split, 6-to-1, or 2014. I cannot see it here. I know because I've been an Apple shareholder since like 2010, and in 2014, I sold Apple, before split, and the price before split, the price was about $600. After split, the price went down to 80 something. What does that mean? The price is. It doesn't mean the crash. It just means proration, right? Because think about it. One share splits into 7 shares. So 600 divided by 7. What do you get? I believe, before split, the price was like 660. So think about it. Simply 660 divided by 7. That was like $94, okay? So yeah, let's say $94. So that means if I had one share of Apple, if I was holding only one share of Apple, still it would be 660. But after split, I have 7 shares of Apple, each share priced $94. So basically my holding, my position, right? My holding is the same. My equity value is still the same. It's still 660. I had 10 shares at the time, so but I sold it at like $600. I mean, before price reached 660. But if I held on to it, I would my position would be $6,600 before split and after split, right? Total holding will. So split doesn't change the value of your stock holdings. It just it just revalues. So a better word is right. It just revalues the stock. So over the life of Apple, if there was no split, and look, by the end of 2020, this is annual price. If I turn it into monthly, and then at the beginning, right, it was like 10 cents. But end of 2020, right, this is 164. This is as of today, I believe. So end of 2021, it was 177. So think about it. What's the growth rate? 177 divided by 0.1, 10 cents. 1,770 times. 1,770 times. So in terms of percentage, it's 17,000 okay, 177,000%, right? In terms of percentage. Again, that 10 cents is the price prorated for splits. In other words, you cannot after split, the price, I told you, the price was 660. After split, it goes down, the price goes down to 94. So all these prices before, all the prices before splits must be prorated for that factor. So if there was no split, right? Think about it. Apple grew 1,770 times. So if you, I told you, at the in 81, the Apple IPO price of Apple was $10. So then think about it. It grew, multiply this by $10 by 1,077. Of course, we know just adding one more zero. If you had one share, if you bought one share in 81, one share of Apple in 81, it would have grown to $17,700 as of the end of 2021. Right? Make sense? But because of the split, no, if there was no split, it would have been like this. And if Apple goes on 1,000 years without any split, it could be a huge number, but it will still be a finite number. But with the split, it will be, it's not like this. It's only like $170 because of the split. And why do they split then? Why do they split? What is the reason? Why do they split? They split because if they don't, think about it. If Apple never split since 1981, if Apple never split, the price would be $17,700 today. I mean, how would you buy Apple? If you want to buy Apple, can you buy even one share? Can you buy even one share? Huh? Unless you have $20,000. Unless you have $20,000, you cannot buy even one share. This is the problem. It becomes less marketable if they don't split. If they don't split, it becomes unmarketable. Now, by splitting, it's more manageable and marketable. I mean, if I have $20,000 and if Apple is $200, with $20,000, I can buy 100 shares of Apple, right? I can buy 100 shares of Apple. And then if I need cash, if I need $2,000 urgently, I can cash out 10 shares. I can cash out easily 10 shares and get $2,000 and leave 90 shares still in stock, earning. And Apple's been growing like, almost at, 3% on average per month. 3% a month is like, think about it. What is annually is 1.03 raised to 12, right? Minus 1. Annually, it would have grown, right? I can take advantage of that Apple's growth, right? With my 90 shares. Does that make sense? So now compare Apple with Amazon. Amazon is somewhere around 2,000 something, I believe. right? If you go to Amazon, find Amazon, one of my where is Amazon? Amazon is okay. I don't know. I'll just type in AMZN Amazon. Amazon is 3,075. Does that mean Amazon is a better stock than Apple? No. Amazon never split, but Amazon has much shorter life. Amazon started in 95, went public in I believe went public in sometime around 96, I believe 97. So you can find the
Professor,
yeah,
isn't that Amazon with 3 splits right there?
Amazon never split.
So what's the S mean?
Well, they split. I'm sorry, they split in early days, but since then they never split. Since 2000. So this
Okay,
price
thank you.
is, of course, post. Everything is prorated post split. It says at the at IPO price would here IPO price would be like $1.50, but that's prorated after split, prorated, right? So, but think about it. Amazon split only in the 90s, but since then they didn't. So, but think about it. For
1220.
say it again. So we can calculate its
I said the session is over, Professor.
I'm sorry, 12:15. So the point is, because of splits and business cycle, the price at infinity cannot be an infinity. It will be a finite number. So let me just quickly wrap it up. So but this will be an infinity. Think about it. 1 plus k, the discount rate raised to infinity. Any number greater than 1 raised to infinity will become an infinity. So a finite number divided by infinity is going to be close to 0. It's not going to be exactly 0, but it will become irrelevant. We don't have to worry about the price of the stock at infinite time horizon. So is the dividend at infinite time horizon. But because we are out of time, we're gonna continue this in the next class. So next class, and then next Saturday, basically how this gets reduced to the reduced formula, right? All right. So that's it for today. Any
Okay,
questions?
enjoy your weekend.
All righty, you too. Thank you.
All right, thank you,
I'll see
Professor.
you guys next week. Yeah. Alpha, you have a question, Alpha? Alpha, you can go ahead.
Yes, sir. Do we have
Yeah.
any homework yet?
No. Look, the homework is automatically assigned by schedule. The homework is the chapter problems. The chapter problems in Connect. Okay.
Because I click connect, it doesn't work yet.
What do you mean it doesn't work? It works. You have to follow the look and the course information.
Yeah, I can confirm that it works. But
It
in
works.
the Connect Lab, it says that those exercises are not like a requirement or something like that.
No, it's an option, but obviously, look, even if it is not it's recommended. Even if it is not a requirement, think about it. Those are exercises. Those are practice problems. If you do that, you will be better prepared for the exams. Okay.
Yeah, but
And
will they give us any points at all, or just practice?
it can. In case you let's say at the end of the semester, remember this class, your semester grade is based on 4 exams: midterm 1, 2, 3, and final, and participation, right? The exams are 20%, 20%, 25%, 25%. So that's like 90%. But let's say you did very poorly in one of those exams. Whatever, for whatever reason, you did poorly in some exams. So at the end of the semester, you are at risk of falling below B minus. And if you're at that risk, I will use the average of all your chapter problems and use that to replace the lowest exam score. So either way, it's going to help. If you're doing it diligently, you'll do better in the exam. So you'll do better. So you are more likely to end up with something greater than B minus. If not, then at least average of all these chapter problems will kick in to boost the lowest grade, the lowest exam score, right? To replace the lowest exam score, so that will boost your overall semester grade. Okay, does that make sense?
Yeah, thank you, Professor. Have a great day.
All righty, you too. I will see you guys. If there's no more questions, I will see you guys next Saturday. Have a great afternoon, everyone. I'll stop sharing, stop recording.